Imagine you own a small trucking business.
Okay, picture that.
Right. And your driver makes like a split-second mistake on a rainy highway, taps the bumper of a passenger car, and then 3 years later, a jury hands you a bill for $100 million. dollars.
Oh, wow. Yeah,
Yeah.
that's the nightmare scenario.
It is. Your business is just gone. Your assets are gone. I mean, everything is wiped out in the blink of an eye. So, welcome to our deep dive. Today, we're taking you through a stack of sources that explore the invisible mathematical shield that stands between a trucking fleet and total bankruptcy.
Yeah, we are looking right at the 2026 truck liability insurance landscape, which honestly sounds like a dry compliance checklist at first glance.
Oh, totally. But our mission today is to show you how this is actually a fascinating high stakes look at business survival. We're going to unpack exactly how underwriters calculate risk, why, a single crash in the wrong zip code can ruin a
Right.
company, and how the massive cost of keeping an 18-wheeler legally on the road affects absolutely everything you buy at the store.
It really does. Because, when most people look at a semi-truck on the highway, they just see the diesel engine and the payload in the back.
Sure, the physical truck.
Exactly. But the real engine keeping that truck moving is the financial safety net backing it up. And in 2026, those nets are under just unprecedented strain.
Okay, so to really understand how this works, we need to establish a baseline for you. Let's talk about primary auto liability. Think of it as the absolute frontline shield for a trucking company.
Right, the very first layer of defense.
Yeah. But to be clear, this shield does not cover the truck itself if it rolls over. It doesn't cover the $1 million worth of electronics sitting inside the trailer.
No, not at all.
It is specifically, exclusively designed to pay out for the damage that the truck causes to others. So we're talking about third-party bodily injury and third-party property damage. If the truck causes an accident, this is the shield that takes the financial hit.
And that frontline shield is absolutely not optional. Primary liability insurance is a strict legal and operational prerequisite across all of North America.
You literally can't drive without it.
Right, you cannot legally turn the ignition key. And you certainly cannot get your operating authority from government regulators without proving you have it.
Yeah.
But what we're seeing in 2026 is that the days of easy, rubber-stamped insurance policies, those days are completely dead.
Wow. Okay.
Yeah. Today's underwriters are intensely data-driven, and honestly, they are ruthless about who they'll actually cover.
So wait, if this primary liability is just foundational compliance, like just the bare minimum cost of entry to play the game, why are underwriters being so ruthless right now?
It really comes down to the explosive scale of modern legal claims. The severity of the worst-case scenarios has just fundamentally changed the underlying math for insurance companies.
Oh, because the payouts are getting bigger.
Exponentially bigger. I mean, a minor accident a decade ago might have settled quietly out of court. Today, it can escalate into a company-ending event.
Okay, let's unpack this. Let's break down how a company actually builds a defense against that, because the sources detail several layers of protection a fleet has to juggle, right?
Yes, there are a few distinct layers.
So you have the primary auto liability, which is that legally required base we just defined. But then there's general liability. Why would a trucking company need that if they already have auto insurance?
Because a trucking company's risk doesn't just magically end when the engine turns off.
Oh, right.
General liability covers the non-driving incidents. So imagine a driver is dropping off a load and someone slips and falls on a wet loading dock that the driver was supposed to secure.
Or like something falls on someone at a warehouse.
Exactly. Or an injury at a logistics terminal.
Yeah.
Auto insurance won't touch that at all. That is where general liability kicks in.
Okay, that makes total sense. And then the sources also talk about something called non-trucking liability, or I think they call it bobtail insurance.
Yes, bobtail insurance.
From my understanding, this is for the owner-operators, right? Like the independent contractors who own their own cab.
Great.
So if they unhook their trailer after a job and they're just driving the cab home to park it in their driveway, they aren't officially dispatched on a load anymore. So the company they were hauling for won't cover them.
Exactly. But they're still driving a massive heavy vehicle on public roads. They still need liability coverage for that drive home.
Got it.
So those layers, primary, general, bobtail, they cover the everyday operational risks. But the real tension, the thing keeping fleet owners awake at night in 2026, lies in what happens when a truly catastrophic crash occurs.
Right, and this is where the scale of these lawsuits really comes in. I like to think of primary liability like the bouncer at the door of a club.
Okay, I like that analogy.
Right, it handles the standard everyday trouble. But if a massive riot breaks out, that bouncer gets overwhelmed instantly.
For sure.
That's when your umbrella or excess liability policy kicks in. It's basically the entire SWAT team sitting in reserve. They don't get out of the van until the bouncer's completely knocked out.
That's a really great way to look at it.
And the reason you need the SWAT team in 2026 is because lawsuits are routinely blowing right past those primary limits. I mean, the numbers in the text are jaw-dropping. Lawsuits are easily clearing $1 million, hitting $5 million, $10 million, and even $100 million. The industry literally calls these nuclear verdicts.
Yeah, nuclear verdict is the industry term, and it usually refers to a jury award surpassing $10 million.
Which is just an unfathomable amount of money.
It is. What's fascinating here is why we're seeing so many of them. It isn't necessarily because crashes are getting more severe physically.
Wait, really? It's not about worse accidents.
Not always. It's because the legal strategies have evolved so much. You have a combination of things like litigation funding.
Oh, where investment firms get involved.
Exactly. Massive investment firms are actually funding the plaintiff's lawsuits for a cut of that eventual $100 million payout. It's treated almost like an asset class.
Wow. That changes the whole dynamic.
Completely. And then you have these aggressive courtroom tactics. Lawyers don't just argue the facts of the crash anymore. They put the entire trucking company's safety culture on trial. They want to make the jury incredibly angry.
So it's about punishment, not just compensation.
Right. They want to punish the company to send the message.
So the juries are handing out these massive punitive numbers. But wait, what does the law actually require a trucking company to carry? There have to be federal minimums to prevent this, right?
Well, there are minimums, but there is a massive disconnect between what the law technically requires and what business reality actually demands today.
How is that?
Well, the Federal Motor Carrier Safety Administration, the FMCSA, they dictate that a large non-hazardous truck over 10,001 pounds only legally needs $750,000 in primary liability coverage.
$750,000. In the era of a $100 million nuclear verdict, that sounds like bringing a water pistol to a house fire.
It's entirely insufficient. It really is. And for smaller commercial vehicles, under 10,000 pounds, one widely cited federal minimum is just $300,000 for non-hazardous cargo.
That wouldn't even cover the medical bills for a serious crash.
Exactly. But here is the real minimum. The free market completely ignores those federal numbers. In practice, the brokers, the shippers, the major retailers who actually hire these trucks to move their freight in, they effectively mandate a $1 million liability baseline anyway.
So if you only carry the federal minimum, you just won't get hired.
Right. Major shippers simply won't let you haul their goods. They demand that $1 million safety net.
And what if you're hauling something dangerous? Does the baseline go up?
Oh, absolutely. If you're hauling hazardous cargo like fuel, chemicals, things like that, those minimums spike automatically to $1 million or even $5 million, depending on the exact material.
Man. So fleets are being squeezed from both sides here. The market forces them to buy these massive million-dollar policies just to even get a job.
Yeah.
And the threat of nuclear verdicts means they often need to buy multi-million-dollar umbrella policies on top of that just to sleep at night. So someone has to foot the bill for all this risk. How exactly do insurers in 2026 decide what a trucking carrier actually owes them?
They use highly complex risk algorithms. And the price tags we're seeing for 2026 are steep.
Hit me with the numbers.
For primary liability alone in the U.S., an established carrier is looking at an average of $8,000 to over $18,000 annually per single truck.
Right, per truck.
Per truck.
So a small fleet of 10 trucks is paying up to $180,000 a year just for the bouncer at the door.
Just for the liability, yes. If you're looking at a complete insurance program, meaning you add in cargo insurance, physical damage to cover the truck itself, and general liability, that total package runs $14,000 to over $25,000 per truck every single year.
That is astronomical.
And we see similar pressures up north, too. In Ontario, Canada, just the liability portion runs roughly $4,000 to $12,000 annually.
But okay, hold on. Those are the numbers for established carriers, right?
Right.
This is where I have to push back a bit because I was looking at the data for what the industry calls new authority status, basically, a brand new trucking business.
Yes. the new authorities.
The sources say brand new operators routinely face $15,000 to $30,000 or more in liability premiums right out of the gate. That seems completely backward.
It does seem harsh.
Right. Why does just having the entrepreneurial spirit to start a new business automatically make you a massive uninsurable risk? You haven't even had a chance to get into a crash yet. Why are they penalized right out of the gate?
It feels incredibly punitive, I know. But if you calmly look at the underwriter's logic, it is purely, coldly mathematical. A new authority has zero loss history.
Right.
They have zero safety history.
Yeah.
To an underwriter, an unknown entity represents the highest possible probability of a crash simply because there is zero data to prove that they are safe.
So no news is bad news in the insurance world.
Exactly. Furthermore, the industry deals with a significant amount of fraud.
Really? Like what kind of fraud?
You have companies that get into trouble, rack up terrible safety scores, shut down, and then try to reopen under a new name as a new authority to escape their record.
Oh, wow. I didn't even think of that.
So underwriters price new ventures according to the total unknown and the potential deception that they represent.
So you're basically guilty until proven innocent by data. How do you actually get out of that penalty box and lower your rates?
By establishing a relentless record of safety data, insurers heavily scrutinize a fleet's CSA scores.
Which stands for compliance, safety, accountability.
Correct. It's the FMCSA's data-driven safety compliance program. Insurers look specifically at unsafe driving violations, vehicle maintenance, and HOS, hours of service compliance.
And hours of service, those are the rules that strictly govern how many hours a driver can be behind the wheel, right?
Yes.
To basically prevent exhausted, sleep-deprived drivers from piloting 80,000-pound missiles down the highway.
Exactly. And everything is tracked by electronic logging devices now. You can't fake it. If an underwriter sees poor scores in those areas, it can trigger an immediate 15 to 50% spike in your premium.
50%. Just for paperwork or maintenance slip-ups.
Because to an actuary, a slip-up in maintenance today, say, ignoring worn brake pads, is a multi-vehicle crash tomorrow. It's a leading indicator of risk.
Wow, okay.
They're also looking closely at your cargo and your operational radius. If you're hauling drive-in, freight-like pallets of bottled water or toilet paper locally within a 50-mile radius, that's relatively cheap to insure.
Because you're close to home, low-risk cargo.
Right. But if you're hauling pharmaceuticals, electronics, or hazmat, and you're taking it long haul across the country, your exposure to risk multiplies exponentially, and so does the premium.
And geography plays a huge role too, right? Let's talk about that, because certain states are notoriously expensive to drive through.
Absolutely. The data specifically highlights states like California, Florida, New York, and Pennsylvania as incredibly high premium geographies.
But wait, are the highways in Pennsylvania inherently that much more dangerous than the highways in, say, Ohio?
No, it's not about the physical asphalt. It's about the courtroom at the end of the road.
Oh, because of the lawsuits.
Precisely. Those states have deeply entrenched litigation climates that expose carriers to a much higher risk of the nuclear verdicts we discussed earlier. Medical costs are higher, the legal environments are more favorable to plaintiffs, and juries in those specific jurisdictions are statistically known to award massive settlements.
So the insurers know this ahead of time.
Of course. So if your fleet operates out of or even frequently travels through California or New York, you pay a premium for that legal exposure.
Okay, so if just crossing state lines alters your legal risk that much, what happens when you drive right off the domestic map and cross an international border?
Oh, that changes everything.
Because North American freight is a highly integrated network. So here's a scenario for you. Let's say I own a fleet. I buy a rock-solid, incredibly expensive liability policy in Ohio. I load up my truck, and I drive a load north across the border into Ontario, Canada. I've got my great U.S. policy. I'm fully covered, right?
You would hope so.
Yeah.
But you have just triggered one of the most dangerous, complex concepts in international freight: jurisdictional whiplash.
Jurisdictional whiplash? I mean, that sounds like a terrible ride at a legal theme park.
It is an absolute nightmare if you aren't prepared for it. Here's why. When you operate inside the United States, your liability, especially regarding the cargo you're hauling, is largely governed by federal law, specifically the Carmack Amendment.
Okay, the Carmack Amendment, what does that do?
In plain English, it imposes strict liability. If you are the carrier hauling the freight and that freight gets damaged or stolen, you are almost always 100% on the hook for the bill, regardless of whether you were negligent.
Basically, if it breaks in your truck, you bought it.
Precisely. But the second your truck's tires touch Canadian soil, U.S. federal law vanishes. You are now governed by Canadian provincial bills of lading. And in Canada, liability is often legally capped at a specific dollar amount per pound, unless a higher value is explicitly declared beforehand.
Wow, so the rules totally flip.
And it gets more complicated. If there's an accident, Canadian courts use comparative fault rules that differ wildly from the U.S.
Comparative fault, meaning the court might decide the truck driver was, say, 60% at fault, but the passenger car was 40% at fault, and they divide the financial damages based on those exact percentages.
Yes, exactly. And how those percentages are calculated and applied vary significantly from a U.S. courtroom, so the underlying rules of the game change entirely.
But going back to my scenario, does my expensive Ohio liability policy actually pay out if I hit someone in Ontario?
That is the ultimate trap. U.S. insurance policies have strict territorial limits. If an accident happens in Canada and it results in a massive lawsuit, your U.S. policy will likely not pay out a single dime unless the word Canada is explicitly listed on your policy endorsement.
Seriously, not a single dime.
Nothing. If it isn't listed, you have a massive multi-million-dollar insurance gap that could bankrupt your company overnight.
So you have to specifically tell your underwriter you're crossing the border and pay for that endorsement. What if I take a load south into Mexico? Is it the same thing?
No, Mexico's an entirely different beast. U.S. insurance policies are strictly legally forbidden in Mexico.
Wait, forbidden?
Yes. Your U.S. policy is completely void the moment you cross the southern border. You are legally required to secure specific, separate Mexican federal law coverage from an authorized Mexican insurer. There is no U.S. endorsement that will save you down there.
Man. And it goes the other way too, right? Like Canadian drivers coming down here into the U.S.
Absolutely. If a Canadian carrier comes into the U.S., they have to meet the U.S. federal filing requirements, which often demand higher limits than they carry at home.
Right.
And Canadian extra-provincial limits, meaning driving outside your home province or out of the country, require at least $1 million in liability, which jumps to $2 million if you're hauling dangerous goods.
So if the stakes are this high and a single crash in the wrong jurisdiction can literally ruin a company, how do government regulators actually guarantee that these thousands of trucking companies are paying their premiums? Because they obviously aren't just taking the fleet owner's word for it.
Oh, definitely not. The regulatory oversight is automated and it is relentless. In the U.S., this involves a crucial piece of paperwork called the MCS 90 endorsement.
Okay, let's clarify that because it sounds like a type of insurance policy.
It's vital to understand that the MCS 90 is not a standalone insurance policy. It is an endorsement attached to the liability policy, and its sole purpose is to prove financial responsibility to the public.
Wait, to the public, not to the trucking company.
Correct. The MCS 90 basically guarantees that if a truck causes harm to a citizen on the highway, the public will be financially compensated, even if the insurance company later finds a technical loophole that would normally allow them to deny the carrier's claim.
Oh, wow. So it forces the payout.
It ensures the victim gets paid. And then the insurance company will go after the trucking company to get their money back.
Wow. So it is purely a safety net for the public, not a shield for the carrier.
Exactly. And the enforcement mechanism for all this is an electronic tripwire called the BMC 91 filing. This is the electronic proof of your coverage that sits directly in the federal database.
Okay, and what happens if that trips?
If a carrier misses a premium payment or their coverage drops below the legal limit, their insurance company is legally obligated to pull that filing. The moment that happens, the carrier's operating authority is instantly flagged.
And what happens when you get flagged? Do you get a warning?
No warning. The brokers and shippers see it immediately in our software systems. You become radioactive. The freight stops moving that very second. You cannot pick up a load.
That is brutal.
It is. And Canada is similarly strict. Their federal rules actually require insurers to notify the provincial authorities before they cancel or reduce a carrier's coverage, ensuring risky trucks are pulled off the road immediately.
Okay, let's look at the big picture here. We're looking at a 2026 landscape dominated by the threat of $100 million nuclear verdicts. We have brand new drivers facing $30,000 premiums before they even start their engines.
Right.
We've got jurisdictional whiplash, incredibly strict compliance filings, and these electronic tripwires that shut down your business if you miss a single payment. It sounds like an impossible landscape. How are trucking companies actually surviving and lowering these costs today?
They're surviving by fundamentally shifting their mindset. They have to move from passive compliance to active risk mitigation.
Yeah.
And they don't have a choice because the insurance market is being battered by severe macroeconomic factors right now.
Like what?
Well, we're seeing sustained inflation, severe labor shortages in the mechanic and repair sectors, and the looming threat of tariffs on vehicle parts and imported goods.
So absolutely everything is more expensive.
Exactly. All of these factors are driving up the cost of repairing a damaged truck and vastly increasing the dollar value of the cargo sitting inside the trailer. So underwriters are looking at this incredibly expensive environment and refusing to take any blind chances.
You know, it reminds me of how health insurance has evolved.
Oh, how so?
Well, in the old days, maybe it was enough to just buy a gym membership, tell your insurer you were trying to get healthy, and they'd give you a discount. But in 2026, it's no longer enough to just buy the gym membership. The underwriter wants to look at your smartwatch data to prove you're actually sweating.
That is the perfect analogy for commercial trucking today. Underwriters draw a very sharp distinction between the adoption of safety technology and the utilization of it.
What does that mean in practice?
5 years ago, a fleet might get an insurance discount simply for adopting technology like putting dash cams in the cabs and checking a box on the application form. Today, underwriters don't care that the camera is installed. They want the real-time telematics data.
They want the receipts.
Yes. They want to see the acceleration rates, the hard braking events, the cornering speeds.
The actual everyday behavior of the truck.
Yes. And more importantly, they want documented proof of utilization. If the telematics system flags a driver for slamming on the brakes too hard on a Monday, the insurer wants documented proof that the fleet safety manager called that driver into the office on Tuesday to review the video and actively coach them on safer following distances.
Wow, they want real-time evidence of a living safety culture, not just hardware bolted into a truck.
Exactly. That's active risk mitigation, and it's the only way to drive down premiums.
So what are some other specific, proven strategies fleets are using?
First and foremost, hiring standards. The data is unequivocal. Employing highly experienced drivers drastically reduces claim frequency. Second, maintaining immaculate, easily accessible Department of Transportation maintenance records.
Right, because if you do get into an accident and you end up in court facing a plaintiff's attorney aiming for a nuclear verdict, you need those records to defend yourself.
Exactly. If your driver files are a mess or you skipped mandatory vehicle inspection reports, a skilled lawyer will use that to prove you have a negligent safety culture.
Yeah,
And that destroys your legal defense.
makes sense. Any other strategies?
Other successful ones include taking on higher deductibles, absorbing more upfront risk in exchange for lower monthly premiums, and actively shopping the market every single year. The landscape is dominated by major 2026 players like Progressive, Great West, Canal, OEIDA, Nationwide, and Travelers.
Good to know.
Yeah, industry data actually highlights Progressive as one of the most active insurers willing to take a calculated risk on those new authorities we talked about earlier.
But there are pitfalls too, right? Mistakes fleets make when they are desperate to save a buck.
Oh, definitely. The most fatal mistake is underinsuring, buying only the absolute cheapest, bare minimum legal policy. If you carry a $1 million policy to save a few $100s a month and you get hit with a $3 million judgment, well, your company is dead.
Yeah, that's game over.
Another common trap is overpaying for misaligned cargo limits. Many owner-operators pay high premiums for extensive cargo coverage they don't actually need for the specific type of freight they haul.
Right, which circles all the way back to why this matters to you, the listener. Because when you're at the grocery store in 2026 and notice that a basic household good costs 10% more than it used to, you're actually paying for this insurance crisis.
I think that's exactly right.
Those $30,000 premiums and $100 million nuclear verdicts, they are baked directly into the cost of moving the freight, which means they are baked directly into the cost of your groceries. Liability insurance isn't just some dry compliance issue. It drives the entire economy.
It absolutely does. It has to be embedded in the culture of every trucking company because the financial ripples affect everyone.
We have covered incredible ground today. We started with the basic definition of primary liability, that frontline shield protecting the public. But we quickly saw how that shield is being battered by the complex reality of nuclear verdicts, the terrifying legal trap of jurisdictional whiplash when crossing borders, and how skyrocketing data-driven premiums are forcing fleets to either adopt active real-time safety cultures or go completely out of business in 2026.
It really is a fascinating evolution. And, if we look at the trajectory of these 2026 trends, it raises an important question, a final thought for you to ponder.
Oh, I like these. Let's hear it.
If underwriters are now demanding real-time telematics and utilizing AI data to constantly monitor actual safety utilization, we are rapidly moving toward a world of perfect digital oversight. In the near future, will insurance stop being just a financial safety net that pays out after a crash and instead become a real-time digital co-pilot that can legally and physically shut down a high-risk truck before an accident even happens?
Man, now that is a wild thought. A liability policy that literally cuts the engine if it calculates the risk is getting too high. It really makes you realize that the frontline shield is no longer just a piece of paper in a glove box. It's a living, breathing network of data. Thank you so much for joining us on this deep dive. Keep asking questions, keep looking past the obvious, and keep exploring the invisible systems that keep our world moving.